Are you currently maxing out your 401k plan and over 50 years old? If so, do you make over $150,000 in 2025? This new rule around 401ks may impact you. You might want to listen in. So we're seeing a new rule right now that's coming out as part of Secure Act 2.0, which was passed by Congress a few years back, and one of the provisions is just now coming due and live in 2026. So if we look at the rule directly and read it, it's Secure Act 2.0, Section 603, and it states, as of January 1st, 2026, employees whose wages from the same employer exceed $150,000 in the preceding calendar year can only make catch-up contributions on a Roth basis. It's a lot of words. So let's break it down a little bit to make it really clear exactly what that looks like and if this is going to impact you or not. So over here, you'll see a flow chart that we put together that kind of gives the breakdown of what it looks like. So starting at the top, the question is, are you over 50 years old? If you are under 50, you're already not making catch-up contributions on your 401k, so this does not affect you in any way. If you are over 50 years old, the next question is, are you maxing out your 401k by deferring $23,500 in 2025, or you plan to defer $24,500 in 2026, which is the updated IRS numbers? If the answer is no, then you're not making catch-up contributions, so this again does not affect you. If you answer yes to both, so you're over 50 years old and you currently max out your 401k, then the third and final question is, are you making over $150,000 in the calendar year 2025? If you answer no to that, if you're making under $150,000 this year, then you can continue to make your catch-up contributions on a pre-tax basis. If you answer yes to all three questions, so over 50 years old, maxing out your 401k, and you make over $150,000 in this calendar year of 2025, then starting in 2026, your catch-up contributions will have to be Roth. Now, we get a lot of frequently asked questions about that piece. What if I made over $150,000 in 2025, am over age 50, but I contribute less than the $24,500? So again, if we look at the chart over here, it's over $150,000, over age 50, but you're contributing less than the $24,500. So in this case, you're not making catch-up contributions. So again, this will not affect you in any way. The next question we usually get is, what if I made under $150,000 in 2025, but I expect to make over that amount when this goes live in 2026? So this is a very important distinction that we want to talk about. It is the previous year's earnings that impact the current year outlook on the Roth catch-up. So 2025 earnings impact whether or not you have to do Roth catch-up in 2026. Regardless of what you're making in 2026, if you make over $150,000 next year, you won't have to do the Roth until starting in 2027. So remember, previous year earnings. Now, what if I made over $150,000 in 2025, but I worked at a different employer? Great question, and that's a wrinkle that's just added in, and it's going to cause a little bit of confusion while lawmakers are figuring that out. But for now, at least as of November 2025, it has to be consecutive years at the same employer. So if you made over $150,000 and you're maxing out your 401k, doing catch up, and you're over 50, and you worked at a different employer, and now starting next year, you're at a new employer and you're still making over $150,000 maxing out. That is a 1-year time period where you can still contribute the catch up to be pre-tax. Now, if you stay at that same employer also in 2027, then you would have to go and do it on a Roth basis unless you switched employers again. So consecutive years, the same employer. Final question we usually get, what if I meet the criteria for Roth catch-up, but your deferral is set to pre-tax? Will payroll automatically switch over? So this is a very important question that's going to be dependent on the payroll that your 401k and plan sponsor utilize. So it's really going to be an important question that you ask your HR. Is it a deemed contribution or a not deemed? Deemed just means that what will happen is they will automatically switch the contribution source over from pre-tax to Roth once you hit that catch up. It's not on you to make any adjustments. If it's not deemed, then you will actually have to manually go in and switch the source to Roth once you hit that catch up amount. That's going to be a very specific question again for your plan sponsor, so make sure you reach out to HR and hope that they have an understanding of the situation on your plan. If you have any questions on this, please piece, please reach out to us and we're happy to help with any way that we can.